Welcome back to the deep dive. We take complex information and try to make it genuinely insightful. Today, we're cutting straight to the heart of Affirm Holdings Inc.'s Q4 2025 earnings. Ticker AFRM. Forget scrolling through endless spreadsheets. Our mission here is simple, a concise but thorough analysis. We're integrating their official data with, real-time market insights. Think of it like your shortcut to understanding not just what happened, but really why it matters and what it might signal for their future. You should walk away feeling well-informed, minus the usual overload. Okay, all right, let's kick things off. We're calling this Slide 1, the at-a-glance scorecard. Basically, the headline performance, how a firm stacked up against what the market expected. And the big takeaway from Q4 2025, a firm delivered what's being called a pivotal financial performance, really an inflection point on the road to sustained profitability. And the numbers, they tell a story. Total revenue hit $876.4 million. That's a pretty solid 33% increase year over year from $659.2 million. So a strong top-line beat there.
Yeah, and what's really striking, I think, isn't just the revenue growth, it's the dramatic swing to profitability. Affirm moved from a net loss of, $45.1 million in Q4 2024 to a GAAP net income of $69.2 million this quarter. That's not just a small step up, it's a fundamental shift, really, in their financial health. And on a per-share basis, you look at diluted earnings per share, EPS, it reversed from a $14 loss to a positive $20 per share. And that diluted figure, it's important because it accounts for, all potential shares from options and warrants. Gives you a more conservative kind of forward-looking view.
And the market definitely noticed that, didn't it? That $876.4 million revenue number, it comfortably beat the consensus estimate, which was around $839.9 million. And similarly, that $1.20 diluted EPS wasn't just a beat. People are calling it a significant beat against the $1.11 consensus. So no surprise, really. After the announcement on August 28th, the stock jumped, 50% in after-hours trading? Clearly, investors like something. So what do you think was the biggest driver behind that leap into profit that got investors so excited?
That's precisely the right question. The market reaction wasn't just about revenue growth, it was about the efficiency. This big improvement, it signals increasing operating leverage. Think of it like this. Affirm nearly doubled its gross merchandise volume, GMV, from fiscal 23 to 25. But they kept headcount essentially flat.
Wow. Okay.
Right. So they're generating much more revenue without, a proportional increase in fixed costs. That's textbook efficient scaling. And a major tangible reason for this bottom line profit. A 41% drop year over year in sales and marketing expenses. A big chunk of that, $65 million, was from something called enterprise warrant expense. It's a non-cash thing that just finished its amortization.
Oh, so a planned reduction hitting the books.
Exactly. A planned expense reduction directly helping GAAP profitability. So this strong performance and the market loving it, it really validates their long-term strategy. Reaching profitability, which they committed to about a year ago, it looks like it's working.
Fascinating. So not just getting bigger, but getting smarter, more efficient. That leads us perfectly into our next section, Slide 2, the engine of profitability. Here, we're going to dissect the core financial drivers, look at margin expansion, basically reveal the underlying health of the business. You often hear about unit economics. For Affirm, a key metric is revenue less transaction costs, or RLTC, is non-GAAP, but crucial for understanding how much value they squeeze from each transaction. Can you break down how that performed?
Absolutely. So for Q4 2025, our RLTC was $425.1 million. That's up a robust 37% from $309.4 million last year. So that clearly shows they're getting more value from their growing transaction volume. Now, here's an interesting bit. If you look at RNTC as a percentage of GMV, it was 4.1%. That's actually down slightly 17 basis points year over year.
Oh, right.
And you might initially think, wait, is that a headwind? Is that bad?
Yep.
But the company points out it's actually a, quote, deliberate and successful strategic choice.
A deliberate choice to see a slight decrease. Okay, that sounds a bit counterintuitive. What's the strategy there and why call it successful?
Yeah, it's a classic case of, looking beyond just one number. The decrease is because of a mix shift towards shorter duration 0% APR products. Now, these products, they inherently have lower RLTC, right? But they are super powerful for getting new merchants and customers on board. They drive overall transaction volume significantly. And what's critical here is that these 0% APR loans are, and this is key, largely funded by merchant partners, which drastically cuts a firm's credit risk and how much capital they need to put up. So yeah, the percentage might be slightly lower, but the strategic wins, customer acquisition, less risk, capital efficiency, they seem to far outweigh that small dip.
Yeah.
Especially since the metric is still above their long-term target of 3% to 4%. It's really about sustainable lower risk growth.
Okay, that makes perfect sense. Optimizing for growth and risk, not just chasing one percentage point. And this focus on efficiency and risk, it clearly shows up in their operating margins too. Affirm reported a GAAP operating gain of $58.1 million. That gives them an operating margin of 7%. That's a huge turnaround from a $73.5 million loss and a negative 11.1% margin just a year ago. And their adjusted operating income, which backs out non-cash stuff like depreciation, stock comp that soared to $237.0 million, that's a 27.0% margin, up from 22.7% last year.
And this is exactly where you see that product strategy directly boosting financial stability, that deliberate increase in 0% APR products. It isn't just about growth. It directly contributes to improved credit quality.
Just to give you some perspective, the allowance rate, the money set aside for potential losses on 0% APR loans, is about 60% lower than for their interest-bearing loans.
60% lower, wow. Yeah. So this focus on lower risk products, plus their, pretty robust AI-powered underwriting has led to a stable credit profile. Delinquency rates are improving. So the strategic shift, it's not a negative. It's actually a direct driver of improved financial stability, builds confidence, makes the whole model more resilient.
Excellent. Okay, now that we get the strategy driving profits, let's zoom in on slide 3, the engine room business segment performance. So this is where we deconstruct where all that impressive revenue actually came from. Looking at the different parts of Affirm's top-line growth, that $876.4 million total revenue, it wasn't just one thing. It was pretty diversified. Interest income grew 24% to $419.1 million. Network revenue up 37% to $306.6 million. Gain on sales of loans jumped a remarkable 67% to $116.9 million. And servicing income grew 23% to $33.9 million. What does this diversification tell us, and specifically what fueled that record-setting gross merchandise volumes, the GMV?
Well, that diversified stream is really a testament to how multifaceted their business is now. The overall GMV hit a record $10.4 billion. That's a massive 43% increase year over year. And the growth wasn't just from one place. It was fueled by their top 5 merchants. Sure, they saw 41% growth. But even more significant was a huge 93% surge in GMV from those 0% APR monthly installment loans we were just talking about.
93%.
Yeah, really validates that strategic mix shift.
But if I had to pick the most exciting development here, it seems like it's the massive growth in Affirm's direct-to-consumer, or DTC, business, and especially the Affirm card.
Yeah.
That feels like a potential game changer.
Oh, you're absolutely spot on to highlight that. The DTC channel is really transforming their whole position in the market. DTC GMV grew an incredible 61% to $3.1 billion. And the Affirm card, its GMV just skyrocketed by 132% to $1.2 billion.
132%.
It's huge. Active cardholders almost doubled up 97% to 2.3 million. And the attach rate, that's the percent of active consumers who also use the card, hit 10%. This isn't just, more numbers. It signals a really successful strategic shift. They're moving beyond just being a financing option at the point of sale with specific merchants. By building the strong D2C presence, driving card adoption, they're building a direct relationship with users. That reduces dependence on any one merchant partner, right? And it creates a much more resilient network effect. They become a sticky part of how people spend money daily.
Yeah, that makes sense. And speaking of shifting models, that 67% growth in gain on sales of loans, it really stands out. Seems like a strong sign of how they're evolving their balance sheet management. What's the deeper story there?
Yeah, it's a really important signal. You're right. This revenue comes from selling the loans Affirm originates to third-party partners. Management specifically mentioned a significant ramp in sales to partners like 6th Street. So what this shows is a strategic evolution happening. Affirm's moving away from being a traditional lender that holds loans on its books, which takes a lot of capital, towards being a more capital-efficient platform. They originate the loans, then sell them. This lets them scale GMV really quickly without needing proportional increases in their own equity capital.
Right.
It's very smart. It lets them monetize their network and, crucially, strategically offload credit risk to others. That's really a hallmark of a maturing, resilient business that knows how to grow intelligently, not just, grow at any cost.
That tees up our 4th section nicely. Slide 4, financial strength and shareholder rewards. Because all this growth and strategic evolution, it has to be built on a solid foundation, right? A healthy balance sheet, smart funding, absolutely critical for the long haul. So, snapshot. As of June 30, 2025, total assets $11.15 billion, total liabilities $8.09 billion, and stockholders' equity $3.07 billion.
But the real story is often in their funding capacity, isn't it?
Exactly. Their total funding capacity jumped dramatically to $26.1 billion. That's a huge 55% increase year over year.
Yeah.
And this isn't just a big number for show. They explicitly state this positions them to support over $60 billion in annual GMV.
60 billion.
Yeah. So basically, they have tons of runway for future growth without capital becoming a bottleneck. That's a massive confidence booster for investors.
And talking about capital efficiency, there's this critical metric, equity capital required, ECR, as a percentage of their total platform portfolio. What does that percentage tell us, and why is the improvement so significant?
Right. So that ratio came in at 3.8%. That's
Yeah.
a significant decrease from 5.4% just a year ago.
Big drop.
Huge drop. And this decline is a direct result of that successful off-balance sheet funding strategy. We just talked about selling loans instead of holding them. This move to a capital-light platform model is a major de-risking factor. Plain and simple. It cuts their direct credit exposure, frees up their own capital for new loans, and ultimately allows for more rapid, efficient growth, doing more with less of their own money at risk. And on top of that, their liquidity position also looks stronger. Total liquidity up $81 million year over year to $2.2 billion. And their net cash position hit $1.1 billion, helped partly by paying down about $188 million in convertible debt.
And maybe the clearest signal of strength and confidence, the board authorized buying back up to $200 million in outstanding convertible notes. How should we read that move?
Well, that decision to return capital to shareholders by reducing debt is a really strong vote of confidence from management. It signals they believe the business can generate enough cash internally to fund future growth. They don't need to hoard cash or rely too much on external financing anymore. It really feels like a defining action of a maturing business that sees a clear, confident path to sustainable profit. It's not just numbers. It's about the conviction they have in their strategy and their ability to execute.
Well said. Okay, we've looked at where Affirm has been, where it is now. Let's wrap things up with our final section, slide 5. The road ahead management's outlook and key takeaways. So where does management see things going? For Q1 2026, the guidance is GMV between $10.10 and $10.4 zillion, revenue $855 to $885 million, and adjusted operating margin 23% to 25%. Looking further out for the whole fiscal year 2026, GMV over $46 billion. Revenue as a percent of GMV around 8.4%. Pretty optimistic outlook.
Yeah, and those guidance numbers are built on a few key assumptions. Management expects that mix shift towards 0% APR products to continue, which fits their strategy. They're also factoring in a maybe modest decline in short-term interest rates, which could help them. And there's an anticipated transition of a key enterprise partner's pay later volumes by Q2 2026. Also interesting, they noted international expansion is not expected to be a major growth driver in FY26. Suggests the focus is really on nailing their current strategy in the domestic market.
Okay, so when we pull this all together, what's the main message from Q4 2025? It really does sound like a pivotal moment, a clear shift beyond just growth at all costs towards a clear and executable path to sustained profitable growth. So for our listener, what are the absolute key takeaways they should walk away with from this deep dive?
Right. For you, the listener, here are what I see as the core insights from Affirm's Q4. First, profitability is the new normal. That feels like the headline. Affirm made a monumental shift to positive GAAP operating income. It's driven by strong growth and smart operational leverage. Doesn't feel like a fluke. Feels like the result of disciplined strategy. Second, the power of the Affirm card. The D2C channel and the card are just proving to be huge successes. They diversify revenue, reduce reliance on specific merchants, and build that direct, high-engagement relationship with consumers. Really secures their spot in daily spending habits.
Yeah, that card growth is something else.
Totally. Third takeaway, capital-efficient scaling is now core. Moving to that capital-light platform model by selling loans and lowering their ECR, that just fundamentally de-risks the business. Signals long-term viability, lets them scale without tying up mountains of capital. And finally, operational discipline and technology create a moat. The results show real discipline, cutting expenses. And crucially, their AI underwriting is keeping credit quality stable even with all this growth. That underscores a pretty robust tech and operational moat protecting their business. So the final narrative seems to be Q4 was the logical culmination of their strategic efforts. They prove they can build this diversified high-growth network while optimizing funding and managing expenses tightly. The strong beats, the optimistic guidance, it really suggests Affirm is entering a new, more sustainable phase of growth.
That's a really comprehensive look, thank you. And just to leave you, our listener, with a final provocative thought. By consistently using a structured framework, like we tried to do today, any investor can really get beyond just the surface headlines of an earnings release. This kind of approach lets you identify the real drivers, assess the financial health properly, and understand management's outlook based on what they're actually telling you. It's a repeatable method, really, for building a deeper, more confident understanding of your investments over time. Okay, the necessary reminders. Please remember, this report is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. All investment decisions should absolutely be made based on your own research and talking with a qualified financial professional. While we've tried hard to ensure accuracy, no guarantee is provided. This report was generated by an artificial intelligence model integrating data from official company releases and publicly available market data. Always, always independently verify all information. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.